Hi, everybody, and welcome to the March 2025 Economic and Market Update presented by Commonwealth Financial Network. My name is Brad McMillan, and I'm Commonwealth's Chief Investment Officer. February was a tough month for U.S. markets as stocks sold off at month's end on rising concerns about growth and geopolitics. The S&P, Dow, and Nasdaq all fell, with the Nasdaq getting hit the hardest. While it was a rough month for stocks, though, bonds did better, as falling interest rates helped support their prices. The 10-year U.S. Treasury yield fell from 4.54 to 4.24% during the month, and this took the Bloomberg Aggregate Bond Index up by more than a 2% gain. International stocks also did better than the U.S., as developed and emerging markets both continued to rally. European defense and industrial names were up on expectations for higher defense spending, while Chinese stocks also gained on expectations for more government stimulus. Although it was a relatively disappointing month for U.S. investors, the fundamentals still show signs of positive momentum. We're currently wrapping up fourth quarter earnings season, and the reports remain very positive. The average earnings growth rate for S&P 500 companies was 14.1%, almost double analyst estimates of 7.3%. Over the long run, fundamentals drive performance, so the strong earnings growth for the quarter is a good sign for investors. And the strong earnings results were supported by a still solid economic backdrop. The January job report showed continued healthy hiring, with 143,000 jobs added and positive revisions to previous reports. This brought the unemployment report back down to 4% in January, which was much better than expected. While hiring was better to start the year, though, there were some signs of potential concerns. Consumer sentiment soured in February, while consumer spending growth slowed to start the year. Consumer spending is the major driver of the economy, so this is an important thing to watch in the months ahead. And beyond economics, markets do still face a number of other risks as well. Domestically, policy uncertainty remains the most pressing challenge. The planned rollout of tariffs on Canada, Mexico, and China continues to rattle markets, with much of the late February sell-off due to the incoming tariff deadline. Another potential risk to keep an eye on is the debt ceiling and the upcoming deadline for a government shutdown. While we'll likely see some sort of congressional compromise, the possibility for a shutdown is very real. And beyond the domestic concerns, of course, we also have foreign risks as well, such as the continued conflicts in Ukraine and the Middle East. Taken as a whole, we have a lot to keep an eye on, and a lot could happen. Market volatility is certainly possible, and we should be prepared to weather any potential turbulence ahead. But despite all these worries, overall, we're still in a good place. The economic and market fundamentals remain supportive, which means that the most likely path forward over time is for continued economic growth and market appreciation. That's not a bad way to end the month. That's it for this month's update. Please join me again next month for the latest news, and in the meantime, stay safe, stay sane, and stay healthy. And thanks for watching.